Hello, thanks for attending once again another video presentation. My name is Seewing Yee from the University Network, and my co-host is Maureen McCann from SpartanInvest.com. Maureen, so without further ado, let me share my screen and talk about this particular title. And the title for this video is Most Real Estate Investors Are quote unquote newbies. Newbies. All right, what I mean by that, so you're going to find out momentarily. All right, cost of waiting. All right, what if your mortgage interest rate stays at 7% for the next 2 to 3 years? Most of you newbies out there, many of you have been with investors, have bought at least one properties in the past when times are good, during the pandemic boom, or even before the pandemic boom, when the real estate investing market was, pretty stable, easy, easy to get into. I mean, as a matter of fact, ever since the last downturn, Marine, the last real estate crash in 2008, from 2010 all the way until 2022, for the following 14 years, we have seen a consistent uptick in appreciation. So investors make a lot of money. Those are good times. So people have the motivation, have the financial means to buy those rental properties. You guys have done well. Now we hit a small patch. And right now, as we speak, in November 2022, Marine, what I found out is that all those negative headlines out there, the recession, inflation, all this, some even call it real estate crash, which is no way that's going to happen. It has all the doom and gloom, fear porn, if you will, free porn out there in YouTube channel, scaring everybody away, even scaring the so-called experienced real estate investors. But don't get me wrong, a newbie, the chances of a newbie, a prospective brand new real estate investor going to get in this particular environment to get in my humble opinion, in my honest opinion, is very slim to none for any newbie right now to enter the real estate investing game, unless you go through a mentorship or coaching or whatever, then maybe. But for experienced investors, it is mind-boggling that too many of you are still sitting on the sideline. So when I talk to some of our investors, experienced ones, so-called, what I found out is they say, oh, right now it's not a good time. The YouTube video said, oh, we need to wait. So think about it. If you wait, the mortgage interest rate for real estate investors is 7 to 7.5%. I know it's a lot higher than last year. So when you say you're going to wait in the sideline, what are you waiting for? And I speak with some investors lately, and they say they don't even know. They don't even know what they're waiting for because they just don't know. And we're talking about experienced investor. So investors, in my mind, the people that bought, they're overconfident. The people that bought in the past, just because you bought one or more rental properties recently during the good times does not make you a savvy investor. The cost of waiting, buy real estate and wait, not wait to buy real estate. I'm using this scenario. Even if the 7% rate to 7.5% in the mortgage rate to get financing for investor, if it stays similar, 7 to 6% in the next 1, 2, or 3 years, let's share what's the true cost of waiting. I provided some of the answers, some of the result of the cost of waiting. If you continue to wait, you forego potential equity growth, potential market debt pay down, potential rental increases you can charge your tenant, potential tax benefits. The list go on and on and on. So now I spill the bean. Now I've gone through my rant, R-A-N-T, rant. So Maureen, what type of thought process, what type of hardcore message you need to tell the so-called experienced investors, many of them are still sitting on the sideline. I mean, how can you trigger, how can you motivate these people to overcome this challenging environment?
Well, yeah, it's definitely switched from how it used to be, but it's still a very good time to invest in real estate because of all of those bullet points that you highlighted. But let me just summarize it by saying it this way. What is the difference between paying 3% on a house that was overpriced? Because think about it, when interest rates are low, it gives people like me who sells turnkey rental properties the ability to raise the price, right? When interest rates rise, real estate prices tend to come down. And so what is the difference between paying, say, 3% a year ago on a house that, was higher priced, let's call it, and maybe I'll take it to the more primary homeowner market, right? Because I think all of you guys remember, there were, the frenzy was, I'm going to buy this house, no contingencies, no home inspection, no appraisal. You can live in it free for 6 months, and I'm going to pay you $200,000 more than what the home is worth, right? So a 3% on a property that is overpriced compared to a 7%, 7.5% that's adequately priced or slightly below market because it's dropped in price slightly. What is the difference between those two? Marinate on that for a second. There's really not. And so the fundamentals of your capital. So look, you guys have a choice. Here's the deal. Here's your choice. You can keep your 25, 50,000, 100,000. I know a guy's got 350,000 right now, and it's sitting in an interest-bearing account that is yielding less than inflation and compounding day after day when that 350,000 is not earning more than inflation. And so why not take that 25,000, buy yourself a $100,000 asset that produces multiple yields through equity accrual, through capital appreciation or equity growth, through the cash flow. May not be exactly what you want right now, but guess what? Tomorrow is coming. And tomorrow there will be a time when the rates are not 7.25. Maybe they're 5.25, 5.5. You refinance, you increase your cash flow position. And while you're waiting for that to happen, you're earning in the depreciation on your tax schedule every year. You're earning with the cash flow, you're earning with the equity accrual, and you're earning with the equity growth. If your 25,000 is sitting in a CD at 3% right now, that to me is silly, because you could take that same money, put it in a hard asset, control the rent increases while you're owning it, and then refinance at a later period of time when the rates come back down. And all the while you were earning multiple ways, and your rate of return is higher than inflation. I know we've shown these numbers in separate videos, but that is how you build wealth. And just like Warren Buffett said, when people are fearful, be greedy. When people are greedy, be fearful. There was a lot of, greedy behavior, but active investing in real estate when the interest rates were at 3% or less for investment properties. And now all of a sudden it shifted and the interest rates are higher, and all of the ones that were buying before, like, I'm going to sit back here now because this makes me a little uncomfortable and a little nervous. But what they're failing to see, the point that they're missing, is the way that you get your capital to grow, and to grow exponentially with a long-term buy and hold, right? So it's kind of a slow and steady wins the race. It is mobilizing that capital that makes you feel safe sitting there. And you know what, hey guys, there are some of you that need to, right? Maybe you're risking your fear of losing your job, so you need that cushion. I'm not speaking to you, but I'm speaking to the ones that have, several hundreds of thousands of dollars sitting somewhere, earning you less than inflation, when you can mobilize that capital, put it into a hard asset that performs in 5 ways. And the one way that you always focus on is that want more cash flow. Well, you can get it when the rates come back down, they pivot, and then you refinance and increase your cash flow position. So that's what I got for Seewing. It's like, don't sit on the sidelines because you're just going broke slowly.
Absolutely. Well said. Maureen, I have something to add. Look, investors, we're not asking you to buy an investment property located in California where the median price of a home is $800,000 to $1 million. It just doesn't work. We're not even asking you to buy a house in rental property in the western region of the U.S., Vegas, Boise, Idaho, Phoenix, Arizona. Those medium-sized median price of single-family home is still at upper 500K. Number does not work. We're asking you to buy in markets that are located in a good, affordable markets. They're entry level. Okay. We're asking investors to buy at affordable entry-level homes, either new construction or resale homes, at only like 150K to 350,000. Where the rent you can collect will pay off your monthly debt service. All you need is risk 25% down payment. So the difference between 3% interest rate mortgage rate that investor got a couple of years ago versus right now 7% or whatever is only a few $100 per month cash flow. I mean, we're talking about small little homes. The difference in cash flow is not gonna determine your financial freedom as of right now. Look, let's say you use an example. In fact, let's use an example I have right here. Let's use this example. So this 7.5% interest rate, yeah, you only get like $60 per month cash flow, but when you refinance 2 years later at 5.5%, and your cash flow is maybe a couple $100 more, that's not going to make that much of a difference. So you cannot retire off on cash flow alone. So, a lot of newbies, you've been taught, oh, you must buy properties at always a very, very high cash flow, et cetera, et cetera. Even experienced investors, they fall under this trap. Oh, to buy a $130,000 property, if I don't get $400 monthly cash flow, I'm not gonna buy. I mean, that is a very narrow way of thinking. That is not the right. You need to pivot to think the reality of what's going on right now. So the difference between 3% to 7%, couple $100 more or less cash flow, I mean, that's cost of a dinner for one night here, anywhere. That's no big deal. Things will get better, but you need to understand, real estate investors have to adapt to the changing dynamics of the market. And right now, unless real estate investors adapt and adjust accordingly, you're not going to stay in the game. Then you're not going to get wealthy. All right. So, any last minute comment you have?
I do, because I was just wanting to run some math, right? So I'm just going to throw out some arbitrary numbers, right? Okay. So let's say we're going to take that. I'm going to say $150,000 house, right? So let's say you out there, you investors, let's say you've got $150,000 cash sitting in some account, right? You could take that $150,000 and buy 4 $150,000 houses, rental properties, right? So that would give you a portfolio of $600,000. Now, what if I'm going to go small on the equity growth, right? Let's just say on that $600,000 of real estate that you purchased using your $150,000, and that $600,000 portfolio earned 4% in just 12 months. That is $24,000. So what you may be thinking of, okay, well, that $60 a month doesn't sound very sexy on that one. Okay, now you've got 4 that are producing, let's call it 60 bucks. So that's $240. Is that right? Yes, $240. And then you earned 24,000 if assuming the properties appreciate at 4% for the year. You're leaving $24,000 and $240 on the table simply because you are using some arbitrary number of the interest rate arbitrary thought of the interest rate is too high, so I'm not going to do it because it doesn't make sense. That might be true if you're just looking at it from, well, I wanted $400 a month cash flow. $60 doesn't seem that great. But what are the other things that you are accruing through your wealth building by holding more assets that you then have control over on rent and then refinancing? So that is what Seewing and I are really trying to communicate. I get it and I was there too, right? Not just a short time ago, we could buy that $150,000 house and it would cash flow a few $100 a month. We like that. We did that all day long. Now that it's shifted, do you think it's going to shift back at some point? It is. And when it does, then you take the advantage of using that tool called the refinance of your 30-year fixed, reset it with a lower rate. Now you push up your cash flow. But in the interim, guess what you guys were earning all along that time that you held that property or properties. And that is what we're trying to convey to you as an investor, because you're looking for, where do I put my capital today? I don't know. I'm scared. Interest rates are high. Inflation is high. I might lose my job. This, that, and the other. All these things that are just worrying you. And this is where we have to use the words of wisdom from someone who is in his 90s, who's lived through many economic cycles. And Warren Buffett said, when others are fearful, and Seewing, are people fearful right now?
Yes, they are.
On a high scale or a low scale? Are they really fearful or just a little fearful?
Extremely high scale.
Exactly. So really, really fearful means you should be doing what others are not doing. And that is being greedy when others are fearful, so that you can be there and capitalize on an opportunity to build your wealth when there's less competition. There's less competition out there for buying because everyone is scared and sitting on the sidelines. So you have a choice. Do something, get something. Do nothing, get nothing. We are helping you to do something so that you 10 years from now go, so glad I listened to Seewing and Maureen, because guess what? Our family right now is so much better because we've got a portfolio of 10, 15, 20 properties right now, and they're cash flowing, and we've got incredible equity growth. We've got equity accrual because the loan was paid down by the renter. And I got to save on my taxes every single year because I was able to depreciate all of those 10 properties, 15 properties every single year on your tax schedule. So whether it's high interest rates, an environment, a low interest rate environment, the fundamentals of real estate are the same. And we're just trying to drill that in your head because fear will paralyze you from reaching financial wealth.
Well, I think I'm better off not saying anything else. I want the
I'm the closer. I come in and just close the Seewing.
I want the audience to just take a moment and pause and replay what you just said the last few minutes. I'm not going to add anything else. So I'm going to save this video for all those folks out there. And you need to play this several times over because this messaging is truly amazing. Thank you. You said it all, Maureen. That's all we need to say. Thank you so much, Maureen McCann. You are amazing. And thank you, everyone, for listening. And this is Seewing Yee, and smash the like button and subscribe to our YouTube channel. You can get more of us. So that's a good thing, right?
I think so. I hope you viewers think so as well. Hope we're getting lots of good content and value out of what we're doing here for you.
Thank you very much. Have a nice day, everyone. Bye-bye.
Bye.